watching The Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thaklial, and today we'll be talking about your portfolio once again. But just in case you're if you've just switched on the television, this is a show where we also do your life financial planning. Just in case you want to send across your questions, you can WhatsApp us your queries on 865-797-4571. We also have an email ID where you can send across your queries. It's themoneyshow@etnow.tv. All right, so let's begin the show. And on the first part of the show, we'll be talking about concentration risk. We'll be talking about how well diversified a mutual fund investor is as compared to a shareholder or someone who has a portfolio in direct stocks. I have with me Feroze Azeez, Deputy CEO, Anand Rathi Wealth. Feroze, good evening. Welcome to the show. Feroze, I want you to help our viewers understand the risk of concentration. It might not sound like a right comparison with someone who has a direct portfolio because if you're investing in equity, you can invest in direct and you can also opt that route via mutual funds. But having said that, we are also we've seen a lot of cases with individual stocks where there have been a fall in one day due to specific reasons or various reasons and different type of reasons. We do have a regulator who is very stringent with all the kind of rules and keeping an eye on all these things and the kind of things that companies come up with or the reasons they come up with. But having said that, if I want to compare a particular stock fall in one day as compared to a mutual fund NAV fall due to that stock, how would you like to explain that?
Good evening, Kavita. Like you rightly said, when people participate in equity, they can participate in different ways. They can buy themselves direct equity. They can buy themselves mutual funds. They can buy, the HNIs can buy themselves PMSs. There are different ways to the same destination, which is equity. So direct equity vis-a-vis mutual fund, which has been a debate which has been going on for decades, which I think can be put to rest very easily with two pieces of data. First, let me give you one piece of data which tells you the concentration risk which direct equity brings, the news risk which you also alluded to, which direct equity brings, the kind of lower research risk which it brings. So all these risks which direct equity brings to one's portfolio, how do you measure that? Now, let's look at last 1 year. Let's not even be worried about one day for the moment, because that one day is the news risk. Like you said, Indocent can be one recent example where there was a little news and then the stock fell by about 25-27%. And that's a nifty stock we're talking about. We're not small, we're talking about some micro cap stock. So coming back, let's look at a 1 year period. So what we did was, this study we tried to see out of NSE 500 stocks, which are just the top 20% of India's stocks, because NSE has 2,300 odd traded stocks, out of which top 500 stocks, there are 6 stocks which are more than 50% down in a 1 year period. Okay, there are 6 stocks. There are 25 stocks which have fallen more than 40% in the last 1 year of holding. There are stocks, 57 stocks minus 30%. There are 25% ke zyada girne wale, 112 stocks. More than 10% fall, 179 stocks. So what point I'm making is a stock can also fall 50%, 40%, 30%, and not 1 or 2 out of the 500. We are speaking about 57 fallen more than 30%. Now let me read out mutual fund numbers for you. How many mutual funds in India in 6 different categories fallen more than 50%? 0. More than 40%? 0. More than 30%? 0. More than 25%? 0. More than 10%? 4, 5, 6. 6. More than 0, matlab 0 to 10% is about 30-40 of them. And there are a substantive portion positives. So the point I'm trying to make is, a mutual fund, even in a year where there's been a catastrophic fall in this calendar year, in the full financial year, you don't see any mutual fund in 6 different categories more than a fall of 25%. Whereas I read out so many stocks more than 25% fall. So that helps you understand and comprehend the risk you take when you buy stocks, let alone the news risk. This is the risk of a 1 year holding period I'm talking about.
The benefit of being diversified, lies in investing through a mutual fund. But I also want to ask this question on behalf of investors who have a very thematic or a sectoral approach in their mutual fund portfolio. And they also they have the same exposure in direct equity also, like for example, auto. Now, over there, the risk is again, in terms of concentration, they are a high risk parameter or category. How can you mitigate that?
See, I personally think, Kavita, going sectorial is also depending on news a lot more. right? Because you will enter a sector. Now you might enter automobile. Tomorrow, if Tesla says, I'm going to sweep this market with different strategy, you will have a problem. Now, just a few days back in telecom sector, there was a lot of noise of SpaceX coming into India. So there could be a lot of things in sectors where all your stocks are of the same kind. So I personally think, for what do we do it? Do we do investing for making money or to feel happy about our intellect? If the objective is to feel more intelligent, then definitely sector it makes you feel intelligent, makes you feel far more intelligent amongst your friends in a coffee table conversation or a dinner conversation. Does it make money? The answer is no. I have done a study of the top 10 sectors. People have always bought the sectors at the wrong time and sold them at the wrong time. They get both the decisions wrong, let alone getting both the decisions right, which is mandatory to make money. So point is, a retail investor who has a day job should not get into sectorial funds at all. Thematic funds, which are a little more broad-based, like in our model portfolio, I have to disclaim that I have SBI infrastructure, which is like 10 different sectors put into one, calling it infrastructure. Even banks are called digital infrastructure. Now, that is at least still acceptable. It will quench the thirst of intellectual stimulation.
Understand this from a fund manager's point of view also, because we have to also explain our viewers how can a fund manager really act when there is a stock specific fall. We saw in a few cases like IndusInd 25%, we saw AGS Transact 80%. Now even though a lot of mutual funds don't have these kind of stock, or they have a restricted or a capped amount of exposure, they still make headlines. Okay, how would you explain to our viewers that one specific stock fall and that exposure in a particular mutual fund will not have a lot of impact on the fund NAV?
So right, Kavita, this is the most important point which you said. See, the mutual funds, equity mutual funds are nothing but a conglomerate or a amalgamation of several stocks. But even if the highest, like when you gave IndusInd as an example, even the funds with the maximum exposure fell in decimals. Not in second decimal, at least in first decimal they fell. They didn't fall. If the stock fell 25, the one with the highest exposure out of the 600 funds also fell by about a tiny fraction of a percentage. So when you go through a mutual fund, you eliminate news risk of a sector and a stock very, very meticulously. But in debt, I disagree. Sometimes when there are debt funds, if there is a default, then the exposures could be large. When I'm limiting my conversation to equity, you should remember that news risk and event risk and a stock risk gets mitigated significantly well. There are example after example. We have seen at least 10 catastrophic falls of businesses which fell, some recovered, some written off, but some companies, all group companies written off. Also has happened in 2018. Let me not name it. But mutual funds investors have come scratch free, except in the bond space where there could be some exposures where the client is not ready to lose money, which is what the nature of debt is. Debt, I think mutual funds have a lot desired in how they've managed debt money, but I should give it to the industry. The way they've managed the equity money has been stupendous, and they've kept the entire Indian retail investor isolated from all these shocks by being a shock absorber in the car.
So when we talk about having strategies in equity, whether it is via mutual fund or if you want to have both kind of strategies, because ideally, an investor gradually needs to progress that to that level where you have a good exposure of equity in your portfolio. If there is, the time horizon is favorable, you have your risk appetite analyzed, etc. Now, having said that, what kind of diversification would be right when you want to be exposed in direct equity via stocks and also have mutual funds?
See, if I'll give you a thumb rule, if you want to get into direct equity, see, I don't have direct equity, and my portfolio has done well, if I have to put it reasonably modestly. I've analyzed the 100 big clients whose data we had. They all believe they're doing beautifully well. When I put it on an Excel sheet and compare it with Nifty, 91% of them were not even beating Nifty at all, but they still believed they were doing very well because they were not doing the mathematics on a transaction-wise basis. To come back to what if you're still hell-bent to do direct equity, I would say if you are in the large cap space, you should at least have 20 stocks. If you are large and mid cap space, you should at least have 30 stocks. If you have large, mid, and small, you should at least have 50. So having 50 stocks is mandatory if it's a flexi cap strategy you're running in the direct equity piece.
All right, I think it's time up on the show for this segment, but thank you so much for taking time out and helping our viewers understand the right approach towards having stock and mutual funds in the portfolio. In fact, how should they approach on having the right kind of stock mix, while they are diversified very well in the mutual fund portfolio as well. Thank you so much, Feroze. Thank you.
Such a pleasure.
All right, time for a quick break, but then post that, let's get to mutual fund portfolio queries analyzed. I'll be joined by Anil Rego, and before I slip into a short break, we are going to send you our WhatsApp number. We'll flag that WhatsApp number where you can give us your portfolio